Building a diversified investment portfolio via crowdfunding. Business angels play a complementary role as investors for companies looking to fund their venture via crowdfunding. Business angels can consider crowdfunding when building a portfolio basically in three main aspects. 1. Co-investing with the crowd via a platform. That is raising the proportion of the funding target that the business has reached under the same investment conditions as the crowd. 2. Providing follow-on funding to a business that was initially crowdfunded. 3. Co-investing in parallel to the crowd on a crowdfunding platform, having agreed your own investment conditions with the company and the platform, and investing outside of the crowdfunding platform. Equity crowdfunding. With equity crowdfunding, you invest in seed, startup or growth companies, usually pre-IPO, but the European crowdfunding offering also includes companies that have already issued an initial public offering. In exchange for your investment, you receive direct equity stakes in the company, though in some cases you may invest into a special purpose vehicle that invests into the target company. Under some structures, you may invest in quasi-equity debt structures. Investing your money across sectors and stages balances the risk of losing capital. Remember the classification of business stages and consider them while building your portfolio. Seed, initial stage of equity crowdfunding to prove product and market fit. Early stage, raising capital to develop product, beginning to scale. Growth stage, product and market fit are well defined. The company is raising capital to scale and increase market share. Seven steps to building an equity crowdfunding portfolio. 1. First, determine your allocation to alternative investments. Equity crowdfunding carries risks other than traditional business angel investments, as you will have a small stake and often no direct involvement in the company. Use portfolio theory to avoid risk. Only invest a maximum of 5 to 10% of your total investment allocation to equity crowdfunding. 2. Then develop a long-term plan. Plan for a period of 3 to 5 years. Some crowdfunding transactions offer dividends, which can reduce exposure. You may not receive a board seat or deeper involvement with the target companies, so be proactive. Be aware of the structure of the transaction, as some pool investors, while others offer direct participation. 3. Develop your first-year budget based on your long-term plan. Take the total allocation you foresee for equity crowdfunding over the next 3 to 5 years. Then, take an adequate percentage of that for your first year. Give yourself some years to build this equity crowdfunding portfolio over time. 4. Identify your true investment motivations. Be clear about your motivation for each investment. Focus either on your monetary return, ROI, or on any social impact you can have with your investment. Social return can be measured by SROI. Neither are measured by the crowdfunding platform on your behalf, so you need to manage this yourself. 5. Now build an active portfolio of 10 to 15 crowdfunding investments, or a passive but large portfolio, depending on available capital and motivation, social or monetary return. Statistically, you are likely to have a less risky portfolio at 100 plus transactions, but you may struggle to manage investor relations with a large portfolio. 6. Diversify your equity crowdfunding portfolio. Diversifying your risk within the equity crowdfunding portfolio is crucial, i.e. investing in a variety of industries, business stages, and regions. Consider platform risk too, but be aware that you cannot easily manage a portfolio across platforms yet. 7. Finally, implement, review, crunch numbers, and adjust frequently. Over the next years, Some investments will result in profitable exits. Some will result in losses. Be ready to directly back winners with larger tranches to take them to the next level. Be aware of lack of reporting and investor relations. These are generally not enforced by crowdfunding platforms, and lack of liquidity, especially when holding a small minority stake. Exits are usually not investor-driven in crowdfunding. Possibilities to get involved. When considering equity crowdfunding, you may invest as little as a handful of euros per project. This way you can experiment at relatively low cost with a number of relevant platforms and companies before committing more. The fee structure on crowdfunding platforms varies. Usually there is a fee on the total amount raised by the fundraiser, but sometimes investors also have to contribute a small fee. The benefits of equity crowdfunding are that you can invest a smaller amount into a larger number of companies via different platforms, without significant time needed for deal structuring or due diligence. The investment will also be more hands-off. However, the smaller stakes also represent a lack of influence and will likely not result in any voting rights or protection from dilution. On top of this, managing a large portfolio of small investments via multiple platforms can be tedious, as standardized reporting systems are not yet in place. Checklist for your strategy. 1. Clarify if you want to be an active or passive investor, if you aim predominantly for social impact or financial gain. 2. Define your overall investment amount, size of portfolio you want to build, sector and geographic focus. 3. Think long term. Get to know and understand the crowdfunding platforms you're considering working with. 4. If you don't know a sector, first check if lead investors have invested and leverage their knowledge. 5. Diversify your investments according to sectors and business stages, maybe also regarding platform and geography. 6. Know the fees that you as an investor must pay, but also the target company. Check for hidden fees. 7. Be prepared for further investments or follow-on deals. Recommendations. If you're an active investor, you should consider building an active portfolio of a dozen or so equity crowdfunding investments to diversify risk. You may be able to gain access to the management by co-investing or giving the option of a follow-on round given certain milestones are hit. If you would like to invest more passively or spread your risk widely across a large number of investments, a larger portfolio, even 100, might be your goal. But keep in mind that non-standardized reporting and contractual agreements about information provision may not make it easy to consolidate such a portfolio, and that you have little influence on the individual companies. Given your success and experience, you should consider replacing investments once one or more have exited, to maintain a fully diversified portfolio.